recovery is only just about to start, and from here onwards, we will revert to a more, at least as far as the US is concerned, a more normal type of business cycle recovery.
I grew up as a fundamental analyst. There are no fundamental excesses. There is no signs of hubris. There is no sign of excess.
Corporates are still in great shape financially. Net debt's not an issue. Cash flow is prodigious, and the labour market's got no bargaining power, so profit margins look well underpinned.
What central banks in many ways are looking as a confirmation that the economic cycle is going to get going is the one driver of potential inflation, which is rise in wages. And what is necessary to drive the rise in wages? Well, it's going to be credit growth and formation of new businesses, which account for 60% of new employment.
But I simplistically think that currency trends, once they really establish themselves, they stay for a very long time. And I'm not predicting the dollar's going to go up in a straight line or anything like that, but I think that's the single most important question on the exam paper.
I think central banks want to raise interest rates. You didn't go into central banking in order to be exciting. You feel a little bit ashamed of having policy rates at such a low level.
It seems that the last 5 years equities have been driven almost entirely by monetary policy. And so if you look at equities for next year through that monetary policy prism, then for us, markets like the US could struggle if the Fed does deliver on some tightening.
If you want to do a risk parity trade, lever credit, duration hedge it, and you'll get an equity-like return with pretty good volatility characteristics.